The number of retirement account millionaires surged last year, according to the new data out from Fidelity. With more details on what drove these gains, we've got the senior columnist here at Yahoo Finance, Carrie Hannon. Carrie, what do we need to know?
Hey, Brad. Yep, great news for millionaires. It jumped. Fidelity's numbers showed that last year, a 27% jump in millionaires who are 401k millionaires. This is, great news on many levels, and we can explain it because, oh my goodness, we had a pretty robust economy last year. Inflation was easing, the interest rates dipped down, the Fed cut those rates, the S&P was up something like 23%. So there was a strong market behind these numbers. And what we found is that, or what Fidelity found, was 4 in 10 of these millionaires are boomers. 57% of them were Gen X and 2% were millennials. And the reason why boomers weren't number one is because they've already started to pull some money from these retirement accounts to use in retirement. But Brad, you got to understand, the reason why these folks have become millionaires is, yes, we had a great year last year, but they have been saving on average for 26 years. And they have put in an average of 18% contributing every year. So that's 18% pre-tax, and that combines employer and employee contributions. That's a lot. And so it's steady, consistent. It's a long-term game. If you want to become a 401k millionaire, you got to be in it for the long haul, be consistent, and keep contributing. And that will make all the difference in the shaky markets. When the markets get volatile as well, you stay the course.
And so, Carrie, there are some people out there who might be getting a bit worried that they don't have $1 million in that 401k. What's the average balance in those retirement accounts? We've got a couple seconds here.
Oh, shoot, 131,000 roughly for 401ks, 127,000 roughly for IRAs. But, Gen X has, 590,000 roughly. So those are average numbers. And you got to remember, people are ticked up. They actually did start contributing more last year, 14.1%. So it's still below the 15% most advisors tell people to set aside pre-tax, but it's getting better.
Carrie, thanks so much for taking the time and breaking this down.
Thanks, Fred.
Ever wonder how the mega, super, ultra rich invest? Well, our next guest has some key insights on how the ultra high net worth individuals allocate their portfolios and lessons you might be able to take from them. To discuss, we've got Anushka Gupta, who is the Goldman Sachs Apex Americas head. Great to have you here in studio with us.
It's great to be here. Thanks for having me.
Absolutely. So let's dive into this. What is the number one trick that you see a lot of ultra high net worth individuals deploying to make sure that they're not just achieving millionaire status, but maintaining it over time?
Yeah, thanks for the question. In our work with very large family offices, we find that two key themes sort of emerge in their approach to investing. One is their ability to take risk, and the other is their ability to bear illiquidity and be patient from a very long-term perspective. We find the investors we work with maintain a large allocation to alternatives. We recently did a survey of 170 global family offices that reflected that the average allocation to alternatives is 44%. As our investment strategy group recommends broadly to our ultra high net worth clients, that recommendation for alternatives is closer to 25%. But many of these families have a multi-generational investment lens. They have other sources of liquidity in their portfolio, and that tends to drive these biases.
Okay, so say I'm not an ultra high net worth individual. I'm just a net worth individual, and I'm trying to invest or at least position like a ultra high net worth individual. What is perhaps the proportional mindset that I should have in order to perhaps bring this into a more kind of bite-sized element for my own investing strategy?
Absolutely. I think the overarching principle is having a plan and an asset allocation framework. The second is diversification, because ultimately, if anyone takes concentrated bets in a certain position or a certain asset class, it can be not the right approach long term. And then I think the main thing is being invested over a long period of time versus trying to stock pick, because ultimately, one, you have to pick the right time to enter. If you sell, then you have to pick the right time to re-enter, and you pay taxes along the way. And so our recommendation to investors is to be diversified and think through the long-term approach to investing.
What percentage of their income even do you see the ultra high net worth individuals just setting aside or just putting straight back into an investment strategy?
Yeah, I think, there's a component to ensure that your lifestyle and your needs are met. But ultimately, we guide it based on what we know a diversified portfolio can yield. And ultimately, this increased rate environment that we've been in has helped to support a lot of the yield and cash flow needs for this investor community.
How is the rate environment really changing, if at all, the thought process for ultra high net worth individuals?
I think it's setting the bar higher, as opposed to just investing in risk assets. There is, from a risk reward perspective, really interesting opportunities in the fixed income markets as well. And so that cash flow changes how investors think about the opportunity cost when weighing one asset class versus another. And in periods where the markets have rallied quite significantly, you might think that giving up a certain amount of return to focus on cash flow instead could be an interesting strategy.
And so what the ultra high net worth individuals also do really well is compound their returns. Where are the kind of early benchmarks that one could set up for themselves to make sure that they're just having a good rate of compounded return over an extended period of time?
Yeah, I think it comes back to diversification, which is the key. But as you think about long-term equity exposure as an example, the S&P 500, which is a market-weighted index, is a really good proxy for that. And so to see how the S&P performs over time with the construct of a diversified portfolio, I think makes a lot of sense.
How do I resist the urge to say, I just want to outperform the S&P 500 every single year? I want to make sure that the S&P 500 is not even in the same stratosphere of the returns that I'm getting on my investments.
Yeah, I think you have to look to money managers and professionals to do that. It's not, stock picking is not easy for the everyday investor to do. But what we think, markets are pretty efficient. There's a lot of information out there today, and so finding asymmetric information in return has become harder. So we actually see that investors look to their alternatives portfolio as an opportunity and a mechanism in the portfolio to actually outperform because you have a longer time horizon. And as companies are private, you may have an edge in terms of what information an investment manager can access versus what companies report in the public markets.
You mentioned alternatives. What is the hottest alternative investment that you see ultra high net worth individuals piling into right now?
Yeah, piling into, there's a lot of the family offices we work with are pretty balanced in their approach. Private equity within the alternatives ecosystem remains the largest allocation of that 44% number I mentioned. That stands at about 26%. Given the multi-generational lens, venture capital and sort of the hub for innovation is a really interesting area of the portfolio as well. And then real estate, you think about your portfolio, what's the goal? Let's beat inflation. And so real estate is an important segment of that portfolio as well.
All right, I was hoping you were going to say collectible sneakers so I could offload some of the ones that I have in cold storage right now. Anushka Gupta, who is the Goldman Sachs Apex America's head, thanks so much for taking the time.
Of course, thanks for having me.
Certainly. We want to turn now to a conversation around building wealth. According to a 2024 UBS report, the U.S. will have more than 25 million millionaires by 2028. And Ramsey Solutions is talking about a method that you can use to become a millionaire using just 7 baby steps here. So joining me now on set to discuss, we've got Rachel Cruz, Ramsey Solutions personal finance and budgeting expert and host of the Rachel Cruz Show. Rachel, great to have you in studio with us.
Thank you. Thanks for having me.
Let's dive right in here. I mean, the first 2 steps, they have to do with savings and debt. So break them down for us.
Sure. Well, the very first step is to get a $1,000 emergency fund. Now, some people, listening or watching may think, wait, what? Is that it? But 40% of Americans can't cover a $400 emergency in cash. So that starter fund of actually having cash is huge. So you can put that just in a high yield savings account. And then step 2 is actually getting out of consumer debt, and do that by listing all of your debts, smallest to largest, regardless of the interest rate, pay minimum payments on everything, and pay the smallest debt off first, because your income is your largest wealth building tool. In order to build wealth, your income is so huge in that. But when your income's going out 18 different directions and payments, you're making the banks rich and not yourself.
Right. After you've essentially paid down your debt here and you're thinking about your house, or minus your house at least, there are 3 steps that kind of spread your money out to different areas. Talk to us about that.
That's right. Well, step 3 is you're going to build up your starter emergency fund to 3 to 6 months of expenses. Again, having that cash liquid to be able to get to when you need it, but having that cash is so important. And then baby step 4 is funding 15% of your income into retirement specifically. So 401k, 403bs, Roth IRAs. And then baby step 5, if you have kids, start thinking about kids' college, 529s, ESAs, and start thinking about their future.
And we have the last 2 steps as well. Finally, getting to that mortgage and ending with wealth. Talk to us about those last 2 steps.
That's right. Step 6 is paying your house off early. And we find that people are doing this in around 9 to 11 years. And this is huge. When you don't have a mortgage payment, there's not only freedom from an emotional standpoint when you have no payments, but also a financial. And then baby step 7, when everything's paid off, you continue to build wealth and invest and be extremely generous.
We were just talking about this in the break before we began our segment. It's the holiday season. I just want to get your take on budgeting through this season and on gifts as well. Talk to us about your approach.
You know, it's really important, I think, to be proactive and to ahead of time say, hey, here's the amount of money we have to spend. You know, we're 2 weeks from Christmas right now, so it may be a little late in the game for 2024, but for 2025, it's the idea of not going into debt, finding margin when you can, but also setting healthy boundaries. I mean, people have really been struggling the last couple of years, and it continues to be expensive when you're going and buying things. So maybe that there is a conversation to yourself, maybe with your spouse if you're married, to say, hey, Christmas may look different this year, but we're actually going to put boundaries up and spend money we actually have versus going and borrowing money, because about 28% of Americans are still paying off debt from Christmas of 2023.
Interesting. Rachel, thanks so much for taking the time here with us today. Rachel is also the author of the new children's book. We have it here on set with us. New children's book, I'm Glad When I Can Share. There you see the book cover on your screen right now. Rachel, thanks for taking the time.
Thanks for having me.
The IRS has doled out almost $163 billion in tax refunds so far this year, with the average person receiving nearly $3,300. That's up about 5% from 2024. So how can you turn your tax refund into long-term financial success? Joining me now is Jason Brown. He's a stock market expert at thebrownreport.com and author of the book 5-Year Millionaire. So tax refunds, which hopefully everyone will get, not everyone is lucky enough to get one, but what are the biggest mistakes that people might make with that tax refund?
I think some of the biggest mistakes that people make with their tax refund is just treating it like it's free money, and that using it to shop or spending it on consumer goods. When you think about it, that's the biggest check that most people get, and they only get it once a year. And so there's a unique opportunity, if they prepared or planned in advance, to put that to work in the stock market and invest it, and put themselves in a situation where that money could generate roughly that amount every year versus just waiting for it from a tax refund.
So, and how do they avoid making the mistakes that you were just talking about?
Yeah, I think first it's about having a plan. And so if you're already behind the curve all year long, meaning you have credit card debt, consumer debt, or things that you've already gotten yourself into maybe a financial situation with, it's hard to then, when you get that chunk of money, say, don't pay off that debt. Or if you've been stressed all year, it's a little bit tough to say, don't take that vacation, because now your emotions are involved and you're like, I feel like I need it because this year has been so rough. But if they can kind of plan ahead, not get in debt, control their emotions, and then say, this year I'm going to do something different with my tax returns, which may mean not spending as much on Christmas gifts, may mean scaling back on birthdays or different things like that, to put themselves in a position where they can use that money to do something different.
Okay, so then when they're presented with that opportunity, they get that tax refund check, they don't have the debt, they're ready to spend it. What do they do, or invest it? What are some of the options? How should they be thinking about it?
Yeah, so that's why I said it all starts with making a plan. I always tell people, if you won the lottery, some people say, I'll invest my money once I have some money. I say, well, great. Well, if you won the lottery today, would you know what to do with the money? If I handed you $1 million, would you know what to invest in? I say, no, I'd go get educated. I say, so then it's not about the $1 million, it's about the education. So get the education ahead of the tax return. Get the education before the money comes, so you know what to do with it. And I would tell people to open what's called a practice account, where you can practice investing in stocks and practice investing in options. And you can get real world experience in a safe environment, so that way when you get the real money, you'll already have a track record of winning or losing, and you'll already know how to buy and sell and what stocks you want to invest in.
And I guess also, if someone gets the tax refund, they don't have to, maybe they can, if they've planned, they can do both. In other words, maybe they can take a small vacation, but then use the rest of it to actually put that practice to work and put their money in the market.
You could. Big picture, there's no real success without sacrifice. And when you think about people's tax returns, it's $3,000, $2,000. When you start to look at the average stock, like Apple stock being $200 a share, I mean, you can only buy 10 shares
Right.
if you had the whole $2,000. So now split that and you spent $1,000 on vacation, you only got $1,000 left. I think that's what discourages most people because they don't see the big enough impact from investing a little bit amount of money. But if they understood the compounding interest and that little bit could grow into a lot if they made the sacrifice up front, they'd be willing to pay the price.
So it's really a mindset change that you're talking about here.
It absolutely starts with a mindset change. And, they say personal finance isn't taught in schools, but that's part of the problem. If it's not taught early, then the mindset is what? Just spend it, I deserve this, I'm getting this back, I'm gonna have some fun. Or sometimes the mindset is, I'm okay making financial mistakes because I know this $2,000, $3,000 is coming back and I'll use that to bail me out. So we definitely have to change the mindset around tax returns, around getting into financial trouble early, and around planning for long-term success.
It's not a windfall. All right, I like that. Thanks, Jason. Appreciate it.
Thank you, thanks for having me.
Our next guest has 7 daily habits that you can implement into your life to help you generate more money, time, energy, and happiness. Joining me now, let's bring in Rachel Rogers. She's the founder of Hello 7 and the author of the book, $1 Million Action. You lay out 7 daily actions to take, but I want to hone in on a couple here. Number 4, particularly, is to do one money-generating activity daily. Give us an example of what this could look like.
Yes, that was so interesting listening to the old money conversation versus new money, which is what I am, right? And so he was saying old money doesn't really know how to generate income, new money, that's where it's at. That's what we do, right? That's our skill set. So taking action to generate money every single day, that means coming up with either a side hustle. Do you know that most workers today, over 50% of people working 9 to 5s have a side hustle, right? And so coming up with a side hustle to make some extra side cash can be as simple as dog sitting, house sitting, babysitting, hosting a yard sale, coming up with an offer, doing a workshop, teaching something that you are skilled at. These are different things that you can do to generate additional income. So that's one thing that you want to think about. And then really paying attention to your money as well. You've got to be focused on your dollars, right? And so that means knowing what's in your 401k, knowing how much you're bringing in, knowing what the gap is between where you want to be and where you're at, and then making sure that you're using side hustles and negotiating higher pay, doing yard sales, buy old furniture, fix it up, sell it, right? These are all things that you can do. And then, of course, make sure you're getting your reimbursements from your employer. If your cousin owes you money, go ask for it, right? We have to pay attention to our money and all the places that it is and call those dollars back in, and then make sure that we are closing that gap that we have where we want to earn more and our paycheck doesn't get us there. You still have skills, right? You still have skills and ability to generate more. And that's our power as new money.
In these 7 daily actions, number 6, I want to go to that one. Look at your money.
Yes.
Every day. How can someone do that without feeling overwhelmed or stressed?
Yes. Well, what's going to make you feel less overwhelmed and stressed is making this a habit. Peter Drucker said, what gets measured gets managed. And I live by that. So I make sure I pay attention to my money and I'm looking at it. I'm measuring it. I'm seeing where is it going. I don't want $1 leaving my bank account for things I don't care about, right? I want to make sure every dollar is going towards something that makes my life better, right? That enhances my life in some way. So you've got to pay attention to your money. A lot of us, when we feel not empowered around money, we put our head in the sand. And that is the opposite of what you want to do. The more you focus on it, the more attention you give it, the more opportunity you're going to see that you have to generate more of it.
While we have you, today is Women's Entrepreneurship Day, honoring female entrepreneurs. I want to know, what advice would you give young women who are looking to start their own businesses?
Yes. The advice that I would give is that you have all the talents and skills that you need within you. I know it sounds hokey, but literally this is how I became new money, right? This is how I went from growing up low income to having money. Is I really just did an assessment to say, what skills do I have? So doing some personality assessments like Colby, Strength Finders, DISC, figure out what you're good at, what your skill set is, right? And then figure out how you can package that into a service or product that you can deliver, right? Come up with an offer that you can sell. Like, I'm good at public speaking, so I can sell a workshop or a training or a seminar, or being on stage, right? Those are some of the things that I can do. So you come up with an offer and then announce that offer to your network. A lot of times we think, well, I don't have 100,000 followers on Instagram. You don't need them, right? You already have people who know, like you, and trust you. When I started my business, I simply announced it to 100 people that knew me. They were my neighbors, old coworkers, old classmates, old professors, right? Just people in my life. And from those 100 people, I got my first 3 clients. And then from those 3 clients, that's how the ball got rolling, where I got more and more referrals. And here I am today running an 8-figure business. So it starts off slow, but it can grow really quickly. So start with that self-assessment and really understand what your natural talents are, how you like to work, what experience you have, and package that into an offer.
Founder of Hello7, Rachel Rogers, continued success to you. And thank you so much for taking the time here with us on Yahoo Finance.
Thank you for having me.
Americans plan to spend a record-breaking $226.6 billion on vacations this summer. That's according to a new survey from Alliance Partners. That is up a little more than 2% compared to last year. But if you're looking to save money, our next guest says a staycation might be the right move for you. Here with more is George Kamel, co-host of The Ramsey Show and host of the George Kamel YouTube channel, as part of our saving series brought to you by Synchrony. George, summer spending tends to creep up on all of us. What are some ways that individuals and families can stay on budget without missing out on all the fun?
Well, it starts before summer. It starts with planning instead of just impulse and FOMO and going, we want to do all the things, just put it on credit cards and buy now, pay later, and we'll worry about it later. So the thing is, you got to sit down and make a plan for what's actually going to happen and then stick to that budget. And so the app that I use for that is called Every Dollar, to just make a plan before the month begins, and my wife and I align on what's happening this following month, and then we stick to that. And if we can't afford it, we just don't do it that month. It's called patience and delayed gratification.
And for those who tend to overspend during the summer months, and I'm mostly talking about myself here, what habits or strategies can help rein things in early, especially as we approach Memorial Day weekend? Many of us, it's the unofficial start of summer.
Well, a lot of it comes down to the marketing. That's when the marketing really ramps up and we see so many ads on our face. And as we scroll social media, and everything is so tempting because they make it seem like it's a once in a lifetime deal. And so again, you've got to budget ahead of time, make a plan for it, and know that all this marketing is coming your way and go, nope, we said we're spending money over here, not over here. I don't care how much is going on sale. Never spend just to save. And if you do that with intentionality, you can actually enjoy the spending you do because it's not impulsive. There's no remorse or regret at the end of it, just intentionality.
In terms of how you're spending your money, how do you view credit cards versus cash? Are there certain advantages when it comes to savings?
Absolutely. You know, I know some of the previous guests have mentioned rewards cards. I don't have a single credit card to my name, and that has allowed me to keep guardrails on my spending because I physically can't spend money I don't have when I only use a debit card, and especially when I use cash. When you hand over some crisp dollar bills at the store, you feel pain. And what's happened over time is that spending has become frictionless. That's Apple Pay's tagline, cashless made effortless. They want it to be so easy to spend to where you don't even feel it anymore. And I think we need to add some friction back in so that we stop feeling so broke. And part of that is because of the frictionless spending. So create the guardrails, use a debit card, stick to a budget, and you'll feel so much better and less out of control.
And let's talk about groceries. That's been a big budget sucker these days. What's your advice when it comes to saving a little bit there?
Intentionality is what it comes down to, and this might mean meal planning ahead of time and deciding what I'm going to go into the grocery store to get. And I love the online grocery shopping now where you can add to cart and see the total before you walk in, before you see that end cap with your favorite snack on it and impulsively grab it before you check out. Just order it online and do the grocery pickup, especially if it's free and there's no added fees. That's a great way to do it. And then changing your grocery store. You know, I went to an Aldi the other day and I was shocked at how much I could get for that $100 bill that I handed over. So you got to change your grocery store, shop generic brand instead of name brand, and make some sacrifices and avoid the end caps and snack aisles. That's where people get into trouble.
I know I get into trouble in those aisles as well, George. Now, you do have a list of 7 baby steps when it comes to getting out of debt, building your wealth. Can you break down some of those for us?
Absolutely. Baby step 1 is a starter emergency fund of $1,000 because we found that 4 in 10 Americans have 0 in savings. And what that does, it causes them to go back into debt anytime there's an ankle bite or emergency. Once you have $1,000, move on to baby step 2. Pay off all of your consumer debt using the debt snowball method. That's smallest to largest balance, ignore the interest rates, try to get some momentum and roll that payment into the next one and into the next one. Once you're debt free, we're going to go back to that emergency fund in baby step 3 and get a fully funded emergency fund of 3 to 6 months of expenses. This is your never go into debt again insurance plan because you become the bank now. You don't need a lender to cover that emergency. And it's a great place to be. Debt free with an emergency fund, amazing financial foundation. Now ready to build for the future instead of paying for the past in baby step 4, where we invest 15% of our household income into retirement accounts that are tax advantaged. That's really going to set up people for wealth. And once you have your own mask on with retirement, you can help set up your kids for college in baby step 5, putting some money away into a 529 plan or an education savings account. And then focus on getting the mortgage paid off in baby step 6. Once you remove one of your largest fixed expenses, you can really begin to build wealth, spend more, upgrade your life the right way, and give more. And that leads to baby step 7, which is just continue to build wealth and give and leave a legacy. And that's really a wonderful place to be. It's a luxury for most Americans to even think about that. But that's the proven plan. It's the same one I followed to go from negative net worth to millionaire in 10 years.
Some small steps that can certainly go a long way. George Kamel, thank you so much for your time.
Thank you.